Self-storage's biggest opportunity just got better, and I'm going to show you how and why. It's a fascinating combination of mom and pop, small market, small facilities, and big institutional tech and data, and the confluence of what's happening today. Understanding this opportunity comes from understanding the problem. You see, in the United States, there's a big difference between first, second tier, big metro markets with institutional players. When you go into those small rural markets, really principally under 100,000 people, the players get different. The competitors are different. And as you go into small markets, that spread gets wider. We see this in everything from financing to actual purchasing price. To put this into an example, today you could be in a big market with a big facility and you could sell that at a 4 cap or a really high value. Now turn around and go into a small market with a small facility and that asset will sell at an 8 cap or half that valuation. It's really big. Now, there's a lot of reasons for this, but at the end of the day, it's supply and demand of the competitors. Now, why that matters? Because the institutional big competitors, they compete differently. They're very operational and tech heavy. It's a very sophisticated market. Now, as you get into those smaller markets where institutional big capital hasn't broken into, it's very mom and pop run. Older facilities, with people that are treating it like a true real estate asset. There's not a lot of fluctuations, and most importantly, there's a lot of inefficiencies going on. Now, this is exactly how I built a portfolio worth hundreds of millions of dollars. We started out in very small markets with assets that were a few $100,000 in total value, where there was really nothing to speak of competition-wise. Small things made huge differences in the facility, and you were able to increase that revenue and net income. So what does that lead to today, and why does that matter? You see, self-storage has changed, and one of the biggest ways that it's changed is in our operations. We've seen this, we've heard about it, even the Wall Street Journal talked about it, about this difference in the price online to the in-place rent, how people give rental rate increases. Basically, operators dropping the street rates to get people in, and then once they're in, they jacked up the prices. You sell a 10 by 10 for $50, they move in, and then that 10 by 10 goes to $200 in a year. That is able to occur through data, operations, and technology. Small markets haven't really seen this in the United States. They don't really think about that. They don't think about operating revenue rate management. Now, why I absolutely hate this practice, and I think it's one of the worst things that has ever happened to storage, I also recognize that it is a basic principle and one of the advantages. I just don't like the lengths that it was taken to. This caused market rates to collapse in a lot of markets during this last cycle. The last 4 years, seeing markets that dropped by 50+% in their rates. Well, that's because they were doubling and tripling rates after the people moved in. This wreaked havoc for financing, buying, acquisitions, and for operators in those markets. Small markets didn't see rate declines like this because that game wasn't being played. But that game is an important one just when it's done right, not taken to that scale where essentially you're kind of screwing the customer. I absolutely hate it. But that's led to a huge competitive disadvantage in these small markets, and the players in them focus on things just like occupancy and nothing really else. This leads to a problem because all that data, what that tells you and what operators are doing is what the street rates are, what your competitors are doing, how you should price that rate, and what you can do with that rate once you have it, meaning rate increases. How high can you give? And what will the market take? It's going to vary a lot depending on market and facility. But when you have all the information, you can see and you can understand. That information is gathered through rate scrubbing, going online and large data software that everybody uses in the industry, gathering up that data and telling you, here's where occupancy, street rates are, and here's what revenues are doing, and here's how they've changed in the past. So when buying, you can actually see where rates are, where they're going both in price, trends, and more. In order to understand what market rates are, what occupancy is, and how those prices have changed, you need to have a bulk of the market to really see that. You can do that because of the way that people are renting. They're doing online rentals, meaning someone comes and rents right through the website. They're pricing online, so rate scrubbing tools can see it all. When you go into small markets, this becomes a massive blind spot. You don't really know what rates are doing and where they're at. They're not priced like that. They're not priced online. And the rate scrubbing tech fails. It just doesn't work. That means that rate management and revenue management tools don't work in these markets. How big of a blind spot is that? Well, in population, it's not nearly as big of a blind spot, but when you look at actual facilities and geographic locations, as well as the amount of cities, it's massive. How big? Well, if we were to determine what reliable coverage looks like, let's say that you need over 60-70% of the competitor rates in that market. That really represents only 2% of the cities in the United States. Granted, those 2% represent like 70% or maybe a little more of the population. But as far as cities go, we're talking about over 19,000 cities that are less than 50% of coverage that we can see. That means that over 19,000 cities in the United States, you really can't use rate management, revenue management, and you can't get an accurate idea of pricing. But those inefficiencies are where the value is. But that value can be harder to find and understand. It can be even more difficult to take advantage of until today. As far as facilities goes, this represents a huge amount of facilities. We're talking about 40% of all the facilities in the United States, 20,000 plus storage facilities that are within this blind spot. And that doesn't represent all the facilities. Those are only facilities that the data that we can pull from TractIQ, which is the second largest data self-storage provider in the world, can even find and scrub. This opportunity is what I built my storage company on. We later moved into second and first tier markets, and we built out a tech ecosystem to take advantage of it. Now, when you're in those markets, if you don't have that ability, well then how do you do rate and revenue management? This is where the big difference has changed and evolved. You see, what we do is we created a software system that allows you to take advantage of rates, pricing, without having to scrub market rates. Meaning, if I don't care what Bob is doing with his rental rate, meaning Bob has 10 by 10s and they're priced at $100. Now, Bob's full and he prices them at $100. Why? Because he feels like that's what it should be. If I take him out of the equation, then what should I price a unit? Maybe that average is actually different. So instead of saying all the 10 by 10s are one price, instead we do dynamic pricing that every unit is a different price, depending on time, depending on how full you are, depending on what markets are, as well as depending who your tenants are. We're in Mississippi right now, and we're turning this storage facility around. Now, lots of people are out trying to buy facilities, small ones that range everywhere from $300,000 to $4 or $5 million. Now, they're worried about getting the money or having the financing. This is why we team up with Live Oak Bank, because they get this. They understand storage. In fact, we have them help us underwrite deals for our students and others, because they are one of the best people in the industry when it comes to getting loans, especially small business loans. They can actually help the customers when they find the asset, understanding how much debt can I get? What's it gonna look like? Not just because of the customer they're working with, but because of their knowledge base. That changes them from being a bank to being a real asset to the customer. We recommend Live Oak Bank to our students as well as others that are trying to get into the storage business. They have an in-depth knowledge of this asset class, so it's more than a bank, it's more than simply getting money. They're actually an asset and a partner to them, helping them go through all the things that they don't know and understand. Now, doing this, we actually move that average up. Now that average, instead of being $100, is $130. Well, that's a 30% increase. And that was the key to the question that I'd always had. Why is Bob determining the price, not the customer? because there's no sophistication or thought going into it. In fact, it's the opposite. Virtually all the operators are doing one thing and one thing only, and that's optimizing for occupancy. But in storage, that isn't the best way to do it. And this comes down to the whole crux that I wrote the 2 best-selling books on and more, is that storage is a business. It's not a normal real estate asset. You're treating it like you would an asset class that economics, operations function totally different. This is not a lease up and walk away scenario. Your customers don't live there. It's not a triple net lease. These are month-to-month contracts, and they change all the time. Tenants move, and demand goes up and down, even by season. The average length of stay in most markets is somewhere between 12 and 14 months. You have an asset that has, let's say, 200 units in a city that has 20,000 people. Now, you only need 200 customers. You don't want 2,000 customers. You don't even have enough units. So why aren't you getting the 200 customers that want to pay $200 for a 10 by 10? Because it's close to where they live, it's quality, and they have the demand for it. Their incomes are different, and their lives are different, including their contractors or whatever else. Well, why don't I try to get those tenants? Not maybe the 1,000 tenants that only care about price and they don't want to pay hardly anything. It's more of a convenience thing for them. Treating it like a business says, I'm going to go after the best tenants or the best customers. This was the question that I wanted to answer. How much is it worth to that tenant? How much are they willing to pay versus others? Because it's not the same. And I don't want all tenants. I just want the best tenants. And I'll let the low-paying problem tenants go to the competitors that just care about occupancy. Well, with the advent of AI and us being able to take large amounts of data, analyze it, and then actually turn it into something functional, we can now do this. That's why I built Now Metrics. Essentially, we look at every single tenant. We take in all the data, we look at our own occupancy, demand, what we're trying to achieve, every single different type of unit, and we price accordingly. Not to what Bob or Steve has it and has had it for whatever reason, but what the customers need and want, and what I'm trying to achieve and what I am offering. Therefore, taking a facility that prices all the units the same at some regular pricing, and I change the way we're doing pricing, therefore upping the overall average rental rate per square foot. Sometimes that means I'm lowering prices on certain units. Other times I'm upping them. Some class of units have low demand, while others have astronomical demand. Sometimes we're in a market where I'm the only one with a certain type of product, and I have way more people that want that product than I can supply. So that price should go up. My competitors don't even have it. So how am I pricing it? What all this technology has done is what technology has done in the past. Democratizes opportunities, meaning the opportunity that was only available for the biggest REITs has now moved down market. That allows operators to do those things and act like a REIT with that kind of technology in a normal market. This opens up the landscape for opportunity to buy and enhance and improve that overall income to tens of thousands of facilities, and for you to buy those mom and pop facilities and turn them into a modern storage facility, therefore dramatically increasing the value. This is the greatest opportunity that we've seen because that playbook has been around. It's what I wrote, but the tools to do it have always been small. So the changes that we were making were simple, although important, like a website and marketing. This is a whole new level that we haven't had access to before. In fact, there was literally no access. I had to build the software to do it because it didn't exist. But the part that I love most about it is this isn't institutions. This isn't massive investors. We're talking about regular, everyday people investing in self-storage, but having the tools that the big boys have. These things combined with online leasing, move in online, ready, available, remote, automated type storage facilities, reducing that expense and increasing the overall gross revenue, therefore dramatically expanding that net income. And that's where the value comes from. Now, because of this, I believe self-storage will consolidate even further than it has. When I got into storage, over 90% was mom and pop. Today, that's around 50%. But I strongly believe in the next 5, maybe 10 years, at the most, we're going to see that go even further to where 80+% of all storage facilities will no longer be mom and pop. That's driven even more because the average age of a storage owner is 67. Over 10,000 baby boomers are retiring a day. All of these things coming together now, after storage has been in a contraction period for the last 3 to 4 years. Supply has been constrained and it's now moving on to another cycle. This has put a pause on acquisitions for years, and as technology is caught up and can now be dispersed and go into smaller markets, right when financing is becoming more available and people are having to sell. All these mom and pops, baby boomers that are retiring or passing away, having to sell their assets. They can be traded and sold to people that can use this and operate a real storage business. And doing so at even less of a burden or a headache than the previous people were. This is a gold rush that, once again, I don't believe will last for very long, because once those assets are all bought and being operated like that, the opportunity is gone. That's why I'm so passionate about people buying and getting into storage today. Cap rates have gone up, prices have gone down. High interest rates, although it's made one side more difficult, it created a buying opportunity because the people selling them in these markets, they are subject to that environment, these high interest rates. They can't sell it at a 4 cap or some crazy high price. They have to be reasonable. So we can buy good deals at great prices and turn them into amazing assets. So what markets are you targeting? Are you looking at storage for the first time? Because if you are, this is the best time to be getting into self-storage that I've seen since probably 2008. But this time it's even better because back then it was harder to get financed. There wasn't a lot of technology to help you operate or run. And even more so, there was just not a lot of information on the industry. Now you have all the tools and all the information that you need. If you want to check out my software, you can. We'll put it in the description below to see how you can do rate and revenue management in small markets that have, until this point, been non-existent and not available for operators. If you want to know even more too, you can always check out our community where we have hundreds of self-storage investors that are first-time investors, already owners and expanding and growing that are buying facilities today. Check it out in the link below and let me know where you guys are buying.